Off your mortgage early or invest? We did the math to find out which nets a great return. Let's find out. I remember when I was living with my family, and one thing that everybody was talking about was to possess a house, right? And pay faster. It feels so good. My mom used to say, no more thoughts, so you can relax and no stress about. I remember I had to drive to Naples to the central bank and pay off the last 10,000 lira, which was 5,000 euro approximately. I remember that we even celebrate that night. That was the mentality of many that even today still adopt the theory. And it's fine. There is always an attachment that is connecting with house. So pay off the mortgage will feel great. But why paying off the mortgage is not probably the best approach. And it should be interpreted by a financial advisor that has a strategy and tips to make the best decision for you. So for sure, have to be something in place and with an unconventional way to do and not a non-conventional strategy. I remind also that this is all an opinion, and I disclaim all that must have a financial advisor before you take any action, please. Hi, I am Daniele Sica. I'm a real estate agent and investor, and I'm here to share with you all these episode tips and tricks for your mortgage and how you should use. So without any further ado, let's start. So best action, refinance and invest more aggressively, because a 15 years fixed mortgage, for example, with a rate of 2.33% is much lower than the market expected rate of return. The second best action, refinance and pay the mortgage aggressively. If the homeowner does agree with the long-term investment return estimate and would rather act more conservatively, they can pay off the mortgage and then invest and still come out okay. Third best action, don't refinance and pay the mortgage more aggressively. So the homeowner will be debt-free 100 months sooner by putting an extra $24,000 a year toward the loan balance, for example. Worst action, don't refinance, don't invest, don't even spend the extra cash instead. Oh gosh. And if the homeowner did not refinance and decide to spend the money, they will not have an extra retirement saving, if that is their goal. Hopefully it's not. And the second worst action, don't do anything at all, right? Bottom line, if the rate on your mortgage is higher than what you might make by investing the cash, it's often better to pay down your debt before investing more. I don't know if it makes any sense. That is unless you consider refinance to secure a lower rate. In fact, I believe refinancing can be a good option wherever or not you ultimately decide to pay your mortgage aggressively. That's the key. The interest rate fluctuated and they are currently at historic low. So be sure you shop around before making any decision or running your own numbers. It's also crucial to look at how far you are from retirement. For example, how long you plan to stay in a home, whether you have other high interest debt, possibility of tax deduction, or status of an emergency fund, right? Or retirement saving. And there are no financial factors to think about as well. Although debit carries a negative connotation, there is such a thing as a good debt too, right? In general, good debt increase your net worth and or help to generate value. For example, take out a mortgage, borrowing student loans, or accessing a line of credit to consolidate debt, for example. While bad debit typically use borrow money, for example, credit cards, payday loans, etc., to purchase goods or services that never have a good lasting value, like a fancy car or material items that you don't play to reselling. Don't get me wrong, we love toys and shiny things as much as the next person, but from an investment standpoint, they are going to bolster your financial portfolio. So good debt isn't something to worry about financially, and it can actually be a great asset if used correctly. That's all we have to care about. And to give you an example idea and pick up some random numbers so you can have a better idea. The longer you hold the property, the more equity you will earn. For example, so let's say you bought your current home of $400,000. Since you have managed to pay, let's say, $150,000 towards your mortgage, and it has appreciated on a value of $200,000 over the last few years. So the fair market value of your home will be $600,000. And the equity in your home is the amount that you would receive if you decide to sell your home and pay off the remaining mortgage. So far so good? So in this case, the equity equals $350,000 minus the 250,000 remaining mortgage. Okay, so it's really, really important to have a good understanding of what you're trying to accomplish before you determine the best course of action. You know these things, right? And that's to help you to illustrate the debate between pay off your mortgage early versus investing. Okay, so thank you for watching. Please, we are here always and appreciate to see your thumbs up and also sharing this video to anyone you may think that will need. We are here always to share the latest news and tips in growing your portfolio. So keep follow us on social media. The link is below to activate the bell for the next video. I hope you enjoyed. So keep investing and see you the next one.